Blockchain Show is a podcast that demystifies cryptocurrencies and distributed ledger technology.
Hello, welcome back. You're listening to The Blockchain Show. I'm your host, Ethan Kinderknecht. Today, I'm here with Peter Harrigan, the CEO and co-founder of Swan Digital, a decentralized global platform that will serve as the foundation for the price-sharing economy by doing so for the $500 trillion derivatives industry, or what Apple did for the computer. Peter, welcome to The Blockchain Show.
Thanks for having me. Appreciate it.
Well, it's great to have you. And that is a lot of money there. Derivatives is something that I used to hear and my eyes would kind of glaze over, but a lot of successful people would take advantage of that. So what got your attention in regards to the blockchain, and how did that kind of form into Swan?
Certainly the idea of using some blockchain tech and certainly smart contracts for the formation of derivatives was not an entirely original idea to us. People had been talking about this for years when I got interested in it. I know that there are people doing things in that area, some very interesting things right now. But when you think about the concept of a derivative, what it is essentially is it's a financial object that derives its value from some other price or financial object. And so the idea that you could pre-program something, kind of the simplest of all possible smart contracts. So it seemed like a natural fit to look into what we could do, kind of using some of the new technologies to change an industry that's been around for over 100 years and that does have a very, very large amount of notional value involved in it.
Yeah. The price-sharing economy it's not really something we have covered in great detail on this podcast before. So would you mind kind of explaining what you mean by price sharing, just for maybe some more of the lay people listening?
Yeah, absolutely. So we're using the term price sharing. Essentially, that's what a derivatives contract does. It allows people to share the price or the impact of a price of an asset without actually sharing ownership. So if you buy an oil futures contract, you're going to get the price of oil, the exposure to the price of oil, without actually, well, at least hopefully, not taking actual delivery of that oil. So that is what derivatives were formed to do, allow people to, who had, say, too much exposure to the price of a particular asset to transfer that to someone else. The reason we've used a different term rather than just standard derivatives and talk about price sharing is that we've been trying to change the way it's done. And so by we're trying to change it in a way where it's more intuitive for the people who are involved. Our system is graphical and sort of visually based, so it kind of works with the way the human brain works better. And because it's visual, you have an understanding of it. There's a couple other things we've engineered into the system to make it safer. All of our contracts are intentionally bounded in price. There's only so much you can make or lose. Collateral is more transparent. Again, it is visual, so you have a better understanding of what you're trading. And we think when you change something like the derivatives industry enough in the way it's done, it almost becomes a different thing. Kind of the example we always use is the phase shifts in water. I mean, water gets very cold. Below a certain point, it starts to act like a different substance, even though obviously it's still H2O, but ice is different than water. And that's why we decided to use the term price sharing to distinguish ourselves from the standard derivatives market as it exists right now.
Yeah, that's good. And I like the comparison to the price of oil. That's something a lot of people can relate to. So, how's it possible for the price of oil to enter, let's say, negative figures, and how can we avoid similar price volatility in the future?
That's one of the things that's quite interesting about the way the standard system works. The current derivative system, which was quite an important innovation when it came about, but a lot of it is based on combining leverage with, in many cases, unlimited risk. So you look at that oil futures that, back in May when we had a point where there were people buying oil futures that dropped to maybe $1 a barrel thinking, well, then what's the most I can lose? Well, it turns out the most you could lose in that case was like $41 a barrel because the price actually went below zero. And the reason that was that we were getting very close to the expiration of the oil futures contract. And at the expiration, if you're all holding a long contract when trading stops, you actually have to take delivery. So, you imagine if you own 10 contracts and each contract is 1,000 barrels of oil, you got to figure out how you're going to take delivery of and where you're going to put 10,000 barrels of oil. So it got to a situation where people were saying, I am happy to sell it for less than zero so that I don't have to take it. That's just recently, some of the conventional players we've been talking to about, potential partnerships and things, they've been having to work out of some of the problems that occurred in April and May in the standard systems where there wasn't a limit, there wasn't an inherent limit to the risk, and people were taking some significant losses beyond what they thought they could. So those people are having to sort of dig out of that. Again, which is one of the reasons we built our system the way we have around this concept of having bounded risk, having the collateral transparent in a way so that you know that the counterparty is good for the trade, and again, where everything's visual. So you have got an actual understanding of the trade that you put on.
Yeah, I like that. There's definitely a huge faction within blockchain tech that is financial in nature, fintech. But just going back to the inception of Bitcoin, it was a way to send cash over the internet. Really, the first use case was money. So it's definitely good to have you on the show because you seem to be at a really good juxtaposition between your past and where this might be going in the future. So I'm kind of curious, just to expand on an earlier question, is how you came to be, your background in trading for like 30 years, and then how did you wind up with a machine learning company and end up interested in blockchain like you did?
Sure. Well, I mean, I had been in the conventional trading markets for a long time because back in the olden days, that's all we had. So I had been in capital markets and trading. I traded upstairs at Bank of America for a short period, and then I traded on the floor in Chicago for a while, traded currency options in Chicago, and then equity options here in San Francisco. And I was on the floor for a long time, and that was a great business until rather abruptly in the early 2000s, it stopped being a good business. It went from really good to really bad very quickly. And I like to say I figured it out maybe 6 months later than I should have figured it out, maybe 8 months, but did figure it out. We went from a system where spreads were relatively wide for a market maker. That's a good thing, and then it went to very tight spreads, payment for order flow, and a bear market all at the same time. And so that that game was kind of up. And so I tried my hand at a few different things, but then in 2007 did get involved. Actually, I had a friend who was interested in starting a company. He'd been in the kind of AI area, and he was interested in starting a company. But one part of it was involved programmatic trading, and so he just asked if he could kind of pick my brain for a while. And we talked for a while, and next thing I knew, he asked me to be one of the founders. I like to say that Sentient Technology, I was the fourth least important founder out of four. And we started that company in about 2007. Was there for 6 years, and we went from nothing to a considerably more substantial company. Although they went on beyond what we had done after I left. But in 2013, when I left, I was in a situation that was unique for me, which was not having to have a job right away. Not having done so well that I could retire to a beach, but not being in an immediate rush to figure out what I'd do next. So I started going to the blockchain meetups down in some in San Francisco, some down in Silicon Valley. Especially going to some of the early Ethereum meetups and trying to learn more about that technology. And so that was obviously, very, very informative and very interesting to go try to learn about this early. kind of came out of that with two things. One was getting involved in the Ethereum pre-sale, which was just luck. The other was running into my partner, Steven, who was at the same time trying to figure out what was going on in this area. And we started talking and slowly developed the idea that we're working on now.
Yeah, that's great. Tell me about the project and a little bit more about your partner and how the platform works.
So Steven is actually an aerospace engineer by training and has done a number of startups over the years. Frankly, there's no way that I could possibly do this without his help and without, I think we have got a good relationship. We sort of complement each other's talents. We were sort of discussing this early on, and again, sort of looking at, can you use smart contracts to develop better derivatives? We started going down that route, but I think we've built something kind of beyond what we'd originally thought of for this. So, part of the technology is in blockchain, but a lot of it is actually just conventional technology. In terms of the UI and things like that, in terms of or how the UI interacts with the back end. Essentially, the way this works is, imagine if you're like, let's say, you got a business with a particular commercial risk where the price of something going down will harm you. Let's just make it. Let's say you're farming pepper in Southeast Asia, and this actually is a real example because in a few years back, Vietnam started growing a lot more black pepper because the climate was well suited to it, and they started growing it in Cambodian farms because they said, well, we now have, we have a similar climate, so we can do this. And so people expanded and started growing more pepper. Let's say the price of this declines, you're going to obviously get a lot less for your crop, and that's going to be very harmful for your farm or for your business. So we wanted to build something that was, simple enough for anyone to be able to use, and that was, again, like we said, visual. So imagine going on to a website and essentially having a sort of a drag and drop technology. You have a line, a curve, and you can say, okay, well, if the price of what I'm selling, say in this case pepper, declines 10%, how much do I need to make to offset the loss I'm taking on my anticipated revenues? And if it goes down 20%, how much do I need to make? So you can just grab that little line and drag it to that in dollar number or whatever currency this is denominated in number, drag it up to that point and say, I need to make this much here, I need to make this much here. If the price of that commodity goes up, you might say, well, I'm willing to take a loss. The system will then take that curve that you've created that fits to your exact need. You can just click a little button to save it, and then click a button to say preview. And so what you do is the system takes your curve, breaks it into some small, fungible, and standardized pieces that we kind of compare to like financial Lego building blocks, and then prices out, looks at what the price for each of these small fungible units are, builds it up to one price for you, and it says, okay, for you to protect from if you're going to make $50,000 if pepper goes down 25%, and you're going to lose $10,000 if it goes up 20%. That's going to cost you $4,000 if you do this trade, and you can just click one button and be done. Obviously, on the back end, there's some more complicated things that are going on. It takes a lot of work to make something simple. And certainly for people who are providing liquidity and trading in these little fungible units, it can be more complicated. But for the end user, we wanted something that's that level of simplicity. You just click that, you've got your price protection, and you're done. So that's essentially how the system works from the standpoint of an end user.
Oh, awesome! It sounds like you're really solving a lot of problems there. And for one thing, a big part of this podcast was to demystify blockchain, and we've been doing it for years, and it's still kind of mystical. It's hard to explain to people, especially people who are new to the space. But it sounds like you're really bringing a lot more people in, or maybe just making the financial system more accessible to people, and maybe also demystifying trading. Is that fair to say?
Yeah, that's absolutely what our goal is. You think about what computers used to be like years ago. I mean, before we had these kind of visual systems like we have now, it was very easy on a computer to get like kind of lost down an alley where you went down a particular route in terms of trying to do something, and you got to a dead end, and you couldn't kind of reverse yourself out of it. And when they started bringing it, when they brought out the Mac and they started out bringing out more visual based systems, it became a lot easier for a lot of people to start using these things. And we want to do the same thing for derivatives. One of the things we've also noticed is that all the growth recently, or not all, but a significant chunk of the growth in derivatives is actually for around trading of financial products. It's not products that real people use, not like Main Street products. Like, we just described a market in pepper, for instance. You could have a market in tea in Kenya, or you could have a market in, say, real estate, regional real estate that would help a small bank hedge its portfolio of real estate loans. That's not the stuff that people are trading in derivatives right now. Most of it is, the biggest part of that $500 trillion number, like 80% of it is interest rate swaps. So it's just, one large financial institution trading with another, where they're saying, I've got a flow of fixed payments, and I want to trade it for floating payments. And these things are, they're great. They work for that section of the market. That section of the market's well taken care of, but there are huge areas that could be addressed. And most derivatives are not aimed at Main Street. They're not aimed at solving the problems of, small or medium-sized businesses. They're aimed at, doing trades that work really well for, big financial players.
Yeah. I'm talking about, some of the more experts in the field. This is a time where people are really unsure of what to do. Maybe definitely listening to quote unquote experts. But in terms of financial experts, what are some instances of failures that have been happening lately, and how it can really impact us all? Because it sounds like this is really a global economy that we're getting into.
Yeah, we've been looking at quite a lot of expert failure recently, and I think that one of the problems we have is we've been building these big centralized systems that are built around experts, and again, centralized expertise. And I think about like the 2008 financial crisis, where the idea was that people, the experts knew exactly how much risk there was in that system. And, you had like rating agencies, for instance, saying that mortgage-backed bonds and securities, they gave them a high rating. And we were counting on, 2 or 3 rating agencies to, tell us what the risk of things were. And they really, they were not up to the task. And in many cases, they were using insufficient amount of data. They just kind of look at how did these things perform over the last, say, 7 years. And that's really not a large enough amount of data to really get that conclusion. I think, another example is obviously what happened recently, which was, has been, I know it's kind of hard to call what we had recently as a financial issue. I mean, the whole COVID issue has been, people's lives, people's health, the economy, the financial sector. But I mean, if you just think about what the experts were telling us in March, they were saying, at least in the US, don't wear masks. I mean, that they actually were going out and telling people, don't put a mask on, and because, don't go buy masks, don't wear them. It's not helpful. It's not a good thing. Got that completely backwards. Now they're telling us we have to wear them. At the same time, and some of the early testing that went on was centralized around the CDC. Their test for COVID failed. When private companies stepped up and said, we'll provide these new tests, the FDA said, well, hold on, we need to screen them. And then the FDA slowed down getting those new tests out, right? So all of these centralized systems around these experts have caused a lot of harm to us. I like to look at, what happened in the coronavirus in San Francisco, for instance, where before the government shut everything down, almost all the tech companies had already had their people working from home for a few weeks. A lot of restaurants and businesses voluntarily shut before there was an order. I think, in fact, the individual people were making decisions with their own information, were making the right calls ahead of these experts. So, we've become very, kind of nervous around hearing, sort of systems of centralized experts rather than things where individuals start to get the power to build their own solution.
Yeah, that's very well said. I don't know what the term would be, getting your own information and acting upon it. Maybe we've seen a split where some people are becoming more dependent on systems in place and other people are trying to find other ways to, protect themselves, for lack of a better term. And then that's just many areas, health, financial, that sort of thing. But, for instance, like my significant other, she was asking me today how to set up a wallet and start dealing with tokens and cryptocurrencies. And I was like, okay, sit down, let's have a talk. And
right.
And it's almost like there's so much risk involved with whichever way you go, but traditional systems seem to have a lot more regulation and safety nets. So my question to you is, how can people nowadays protect themselves, either themselves or their business in this high volatility market?
Well, I think it's actually great that you brought up the example of these wallets for dealing with crypto, and they have advanced pretty quickly in the last 5 years or so, right? But there's still work to be done. It's still there's still things that are going to come along that'll make it more intuitive for people. One of the examples the term we've been trying to use is this kind of idea of embedded expertise, where you build the expertise into the tool itself. And the example that I always use is not really from blockchain or finance, but I always think about, like, if it's 1998 and I said to you, hey, I'd like you to film a video and I'd like you to edit it and put it on the internet in a way that a lot of people could share it and see it. It's like, okay, well, I got to go buy the right camera equipment. I got to figure out how to, upload it onto something and figure out how to get some editing software. The technology existed. It was just a hell of a challenge to do. Now people do a TikTok video off of their phone in, a couple of minutes. And they don't have to be experts in all these things. The expertise is built into that. Now, in the case of TikTok, there's some other things built in that might not be so good, but there certainly there is a lot of expertise built in to make it very easy for people to use. And I think that's where this whole area is going. I think we're going to find ourselves in a situation where the wallets people can use and can access will become, very simple, very straightforward, very intuitive, and easier for normal people to use without becoming experts in what is, frankly, still a somewhat esoteric field. From our standpoint, the solution we're building is slightly different. This is around price risk, but we're trying to embed the expertise of derivatives trading into the tool in such a way that, for instance, if you don't know anything about trading, you know anything about options, you can create a payout curve that matches exactly what you're trying to do without knowing how, options work or futures work or any of that, right? All you'll know is you'll see in front of you that, hey, if the price goes up 20%, I make $10,000. If it goes down 15%, I lose $6,000. You don't have to know more. And so I think that is going to be the trend in this area, making it more and more usable. And, we're trying to do our part in our area that we've carved out.
Yeah. Well, it sounds excellent. In case there's anybody listening who would like to, potentially get involved, what would the process look like?
To get information about us, we have a Medium page, which is medium.com/Gray Swan Digital. In our case, the Gray is spelled Grey. So it's Grey and then just Swan Digital. But if they want to contact us, ask any questions, you can reach us at newfinance@grayswanmail.com. So again, that Grey rather than Gray. And we'd be happy to answer any questions that anyone had. Just drop us a line and we'll talk.
Awesome. We've got a few minutes left here. Just wanted to give you the opportunity to maybe tell us some more about what you're excited about.
That's a great question. We've been very busy recently in terms of designing kind of the next version of the system. The version that we have right now has a lot of the UI and elements involved, but is not as scalable as what we're intending to build next. So we've been spending a lot of time going into the detail of how to make that work. So that should be something that'll hopefully be available to more people, one form or another, sometime maybe 6 to 9 months from now. That's kind of what we're up to. Anything, is there anything else that you'd I don't know if there's anything else I can answer. I'm happy to.
I guess maybe maybe the roadmap for when people can sign up or.
Yeah, no, I think the roadmap that we'll be looking at is we'll be going into a beta probably with a partner towards the end of this year or early next year. In which case, we're trying to go in and harden the system, make sure that some of the bugs that are probably in there get ironed out so that we don't. Nothing breaks on anyone and causes anybody any trouble. But I think as that progresses, it'll start to become more public through a couple of different possible channels. There's a couple of things that we built in. We built it in such a way that we can do this in a sort of purely decentralized finance method, or we can do it in partnership with partners who already have kind of regulatory status. So I think for us, what's going to, the big decision point coming 9 months from now or so is going to be whether this is purely decentralized finance or whether it's, through some existing players, either in the blockchain space or in the conventional space where people can come in through that. And that's going to be a question of, what do people want? What does the public want, and what do the users find works best for them? And that's just something we're not going to have the answer to until a little bit further down the road. But once we have that, we'll know which way will be the most effective way to bring it out to a wider audience.
Yeah, and I like what you said earlier. The comparison between uploading a video in the late '90s to now kind of reminds me of Apple computers when they came along and really revolutionized the personal computer for everyone, and how industry followed, and it just kind of compounded from there. We've seen some wallets are very popular, like Coinbase, and there's others out there that are available. But I'm just curious if you see any trends emerging, or what do you think needs to happen for to make distributed ledger technology or just cryptocurrencies in general more accessible to people?
Yeah, we do need to increase the accessibility, right? And I think, you look at Coinbase, it's really, really easy. It's at least the standard platform for it, is the easiest thing you've ever seen, right? You say, I want to buy this much of it. That's pretty simple stuff. On the other hand, the level of fees are pretty stiff too. So I think, although obviously I know they have a more professional platform people can go to and have lower fees. But I do think that is, look at the level of success they've achieved, right? They don't offer you, or at least did not offer, a huge number of options. When you first started using, when Coinbase first came out, there was no way to say, look, I want to buy Bitcoin if it drops $100, right? You couldn't put even a limit order in, right? So, now again, through their more trading oriented platform, you can do that kind of thing. But mostly they just made it really, really simple. And I think that kind of interface, I've traded on a couple of exchanges where, it takes a while to get to where you can actually place the order, right? Someone we worked with said he was talking to a professional trader, and he showed him one of the exchanges, and I don't want to name any names, but he said that he brought the guy onto his account, and he goes, I'll give you $1,000 if you can figure out how to place a trade in under 2 minutes. And so far, he never had to pay anything out, right? So I think we are going to be seeing an evolution towards more intuitive and simpler tools, right? It's just going to have to happen if we're going to bring the kind of adoption that we want. I mean, you have this amazing technology, and you have this amazing, I mean, certainly from the financial standpoint, the ability to own, say, Bitcoin and have a currency that they can't just print more of, right? Or if you own Ethereum, and you can do a lot with it. And there's a lot of these things that are coming along, which are terrific, but they're going to have to be easy for people to understand and to use. And so I think that's the big trend that I would see, is this, moving towards more intuitive solutions, not necessarily, I mean, in some cases, giving people, empowering them with more abilities and with great new, whether it's a faster system or a cheaper system, that's great. But just make it easy for people to understand, because there's a lot of people out there who haven't come into this space that we're both involved in, but and we'd love to have them come in, but we're going to have to make it simpler for people to participate.
Right. And something that fascinates me about just this whole topic in general is the idea of money as a human construct. And some people, as we mentioned earlier, they complain about cryptocurrency and how volatile it can be. But I kind of wonder, what's the traditional, fiat currency hidden volatility that we don't really see? I mean, it's just baked in everywhere. We see prices at the grocery store. We just kind of accept it. It's gradual, but there's inflation. There's all sorts of technical things that most people don't understand. Is there any hope that cryptocurrency can become a viable option for people, or how do we help them understand the difference there?
Yeah, I think it's a good point. I actually wrote an article about this for a while ago and put it on Medium, talking about the fact that, I mean, first of all, you're right. You have, there's a big difference between volatility and which is, obviously the price swings around, but it can swing in both directions, right? I mean, fiat currencies never appreciate 20%. And when they do, people get kind of worked up about it. So, sometimes currencies will appreciate relative to other currencies, but generally it's a one-way train, right? You see the value of your dollars drop 2 or 3% every year. Occasionally, the rate at which you're losing value is considerably higher, right? Sometimes you get to 10 or 15% inflation. And then, currencies in general, fiat currencies, the standard pattern seems to be a sort of slow decay of the value people are storing in them. And then every now and then a massive decay all at once, right? So when you get currency collapses, they come on pretty quickly. We've had quite a number. I mean, in the period since 1971, I think we're looking at like 30-ish currency collapses. So it's been a substantial number of them in a lot of places. Sometimes in the U.S. we think we're immune to that, but only time will tell. At some point, we could be facing that problem here too. It is a real and very significant issue that you brought up, and I think, with the amount of money printing that the Fed has been doing recently in response to the crisis, and the amount that we probably expect them to do in the next 6 months, I think people are going to start to realize that maybe it's okay to own a Bitcoin and know that the price might drop 20% before it goes up 30%. But that's better than just owning something that continues to decline in value.
Yeah, very, very good point there. I have a topic that's been on a lot of folks' minds this last month or two is inequality.
Oh, right. Absolutely.
I kind of was lulled into this false sense of, everything's great, a kid of the 90s, I also grew up in the Midwest, and then I moved to California, and I discovered, wow, things are not quite as I thought they were.
Right.
And I don't know how much of that is the media spinning a narrative. I just don't know. But something that I really like about distributed technology is, the decentralized nature, and there's got to be, economic advantages for people that maybe systemically weren't there before. Do you think there's any truth to that?
Yeah, I think it's a really good point. And there's been a lot of, one of the beautiful things about this space is that you hear people talking about what really is money and you talk about, people talking about the Cantillon effect and things that you would never hear discussed normally. And, there's been discussion of inequality throughout most of my adult life. And I think you could make an argument at one point that, well, some of it was just the tax system. When you lowered marginal tax rates, it made sense to pay people more. And so instead of giving people a perk or having the company pay for something for an executive, they just gave more money. And so inequality just became more visible, but it had already been there. But if you really look at this period since 1971, it's amazing how much of the, we've had economic growth, pretty substantial economic growth, but most of the gains of that growth have gone to the top. And that is, in fact, something that would have been predicted by the Cantillon effect when you start printing money, right? When you increase the money supply, it can't go out to everyone equally. If it did, what would be the point of increasing the money supply, right? It ends up, going to certain favored groups. And, people who have access to that money first, financial system would be one. I think the number I read recently is that just the PPP funds that the government is dispersing to small businesses, all the banks together are going to make about $18 billion in fees off of that, right? And that's a pretty nice, boost to their bottom line from this printing of money. And so, yeah, we have seen this shift where wages have not gone up, but the price of houses certainly in San Francisco have, right? So that's just increased inequality between people. And the most shocking thing that I've sort of discovered looking at the numbers is even if you look at black versus white income in the country, we were making a lot of progress before we went to just fiat printed money in moving towards equality, and then it just kind of stopped. So in the early 70s, the ratio of black income to white income on average went from it was getting closer and closer to moving towards parity. I mean, there's still an inequality, but it was moving in the right direction. And just flatlined. And you have to wonder why it is that in that period, it's just been, there's so little progress that's occurred. And it's really kind of a frightening thing. Whereas, I think the idea of having a solid money where it's not printed by, well-connected groups, or not printed by well-connected groups, but printed in a way that benefits politically connected people, could end up in a situation where where the benefits of economic growth are more widely distributed like they used to be in the past.
Yeah, well, that certainly is encouraging. And I really like our conversation today. And I want to thank you for taking the time to speak with me and our audience. And, it's something that I want to definitely learn more about, and something I haven't really considered. So I know that you mentioned this earlier, but just in case anybody's driving in their car or jogging or wherever they're listening to this and they missed, tell us again where we can go to learn more and potentially connect with you.
Sure. Just send us an email at newfinance@grayswanmail.com. That's GREY, spelling of gray. Or they can look at our Medium page, medium.com, Gray Swan Digital. And but anybody who reaches out, we'd be happy to contact them back and answer any questions they have.
All right, Pete, thank you so much for your time. It's been a real pleasure talking to you today.
Well, thank you, Ethan. I really appreciate the opportunity to come on. Thanks for having me.
Yeah, my pleasure. Have a good rest of your day.
You too.